Welcome back. Earlier today, the CPI Consumer Price Index was reported. Today, we're going to tackle the following questions. Exactly how hot is inflation? What type of inflation is rising? Exactly how long before the Fed cuts rates? Which inflation are we watching? Which inflation is the Fed watching? On Reuters, slightly hot December US CPI suggests the Fed won't rush to cuts. This is on Reuters. U.S. consumer prices increased more than expected in December as rents maintain their upward trend, which could delay a much anticipated interest rate cut in March from the Federal Reserve. Consumer Price Index released at 3.3%, and we can see this exceeds the last 2 months. We're at a 3 month high on a year over year basis for Consumer Price Index. Core CPI, excluding food and energy, which are considered to be more volatile components of the inflation measure, that was released at 3.9%. And we can see a continued trend to the downside. Excluding food and energy, we see a lower low. However, notice the 3.9%, excluding food and energy, is still higher than the 3.3%. So we have a tale of two cities, so to speak, in terms of the inflation measure. Now, CPI, the standard number, was greater than last month. That's where the hot CPI is found. Core CPI, excluding food and energy, was below last month's report. Therefore, currently, the strength in the CPI is found in part in food and energy, also rent and some other sectors as well. On a month over month basis, we can see the CPI and core CPI both released at 0.3%. So the monthly change, there's not a lot to report here. However, on a year over year basis, we can see the core CPI at 3.9% is greater than the standard CPI. So excluding food and energy, the core CPI, which is really everything else, is actually higher. Notice in particular, food on the outside up 5.2%, restaurants up 5.2% on a year over year basis. Electricity prices 3.3%. That's our food and energy. Now, interesting to see, airline fares were down 9.4%. That's where the savings is. And then finally, rent, which is what Reuters was referring to, up 6.5% year over year basis. A lot of increases in rental prices. Now, going back in time, 2007, the consumer price index fell below the 2% inflation target, but it bounced. Inflation's a funny report. It's very stubborn. We can see here the white line represents the inflation target. That's where the Federal Reserve wants the CPI to come down to before they start cutting rates. Well, we can see we came down to 1.4% in late 2006 and again 1.9% in late 2007. The red line represents the interest rates, the Federal Reserve borrowing costs. And we can see they did not start cutting rates until it was certain that inflation was going to stick around the 2% level. That was in late 2007. But now we see the core CPI, excluding food and energy, 2.1%, but it bounced off the inflation target. Inflation numbers are very, very stubborn. The core CPI bounces back up. It only actually really approached that 2% target once during that entire cycle. Now, we see here the red line represents interest rates, and the Federal Reserve finally cut rates when the core CPI really maintained its levels right around just a little bit above the 2% targets. And that's the reason why the Fed prefers to watch core CPI because it is not as volatile. It does not include food and energy. Food and energy are more volatile components. Food prices, are dependent on supply and demand forces within farming, for example. Energy prices are certainly susceptible to outside influences as well. So when you exclude food and energy, that's really the CPI that the Federal Reserve likes to watch. Present day, 3.3% on consumer price index, still well above the 2% inflation target. Inflation is stubborn. That means steady rates. Federal Reserve doesn't have any reason to cut rates anytime soon. We're still well above the 2% targets. Core CPI, 3.9%. Now it is declining, We are seeing progress to the downside, but still, once again, above the 2% target. It's still above the 2% target, and we know this is the inflation number the Fed really likes to watch. Now, going back in time just for a moment again, 2004 through 2009, we have several different sectors within the Consumer Price Index report. Specifically, take a look at the white line, electricity. It's a very resilient, steady form of inflation. So we use this as a barometer, really to try to get a gauge as far as where the inflation is. However, there are three very sensitive sectors to the inflation report: the green line, used cars; the blue line, airline fares; and gasoline, of course, the purple line. So we can see here between 2007, 2008, we saw a real big decline, especially in gasoline. Well, fast forward to present day. What can we learn from this? Well, it's the same lesson all over again. The white line, electricity, still very resilient, declining but steady. The three very sensitive sectors: used cars, gasoline, airline fares. In particular, airline fares, year over year basis, down 9.4% on the current report. Certainly a long trend to the downside, to be sure. And we can see these are some of the weakest sectors within the consumer price index. To go back, how hot is inflation? Well, CPI 3.3, core CPI 3.9, both are still well above the 2% inflation target. So, barring any other developments, the Fed still is not in a position where they want to cut rates anytime soon. What type of inflation is rising? Well, the latest report is CPI, including food and energy, but also we know rental prices are going up, restaurant prices as well. It's a broad based rise in inflation. So it's not one specific sector. Exactly how long before the Fed cuts rates? Well, we're going to talk about in the next couple days the Fed funds futures, which I believe they forecast around a 64% chance the Fed will begin to cut rates in March. However, that is left to be seen. We still have PPI to contend with as well later on this week. Which inflation are we watching? Well, those three very sensitive sectors, I think, are very interesting to watch. Airline fares, in particular, were down a lot. Gasoline certainly is also very interesting as well. Also, rental prices seem to be something that is very much reported on lately. Which inflation is the Fed watching? Or CPI. Take out food and energy, the more volatile components. That really is a true gauge. At least that's what the Federal Reserve is thinking. Now, if you haven't already, please visit our brand new Substack newsletter, The Business Cycle, our first article published there. There we take a very in depth look at the long term business cycle as dictated by stocks, commodities, and bond yields, and it really helps us classify where we are on the long term cycle. So, to visit that article and many more in the future, go to substack.com. No registration required, no email required. Just simply go to this website and then enter our name, just the data. And make sure you put the underscores as well, just the data. As well, please visit our Twitter page, just the data, where we post interesting ideas on a regular basis as well. We hope this has been helpful. We look forward to seeing you back soon.